So we move to chapter 17, Consolidated Financial Statements. This chapter is not dissimilar to chapter 3, if I could take you back to the regulatory conceptual environment. In one way, it's sort of very, very different to the other chapters within this particular course, because it's very much focused on computations. Consolidated financial statements are really about a series of different calculations. I mean, obviously, any set of financial statements involves calculations, but consolidated accounts, we're bringing together two sets of accounts and possibly more. Let me explain a little bit further as we run through the sort of intro here, and indeed the principles of consolidated financial statements. We're really talking about group accounts. We're talking about groups of companies. In essence, we're saying that, many entities, carry on part of their business through controlling other companies, i.e. subsidiaries. So you would have a holding company, let's say, or a parent with a number of subsidiaries in which they have investments in. Now, as I say, this particular chapter is about calculations in relation to how a given parent company or a holding company brings in elements of the subsidiaries' accounts and really joins them together, adds them together, if you will. And consolidation is really about adding up sets of accounts, but there are a number of small, slightly quirky, and in some places tricky little rules. So going back to my point about chapter 3, certainly chapter 3, the regulatory environment, etc., is all about, the standard setting, the boards, the committees, the interpretations, the trustees, etc. Very discursive. This is the opposite way around, which makes it stand out in this group of 18 chapters. So for me, certainly without scaremongering, it's a tricky little chapter here. And indeed, my approach to this particular mind map is more overseeing rather than the detailed calculations. I think the detailed calculations we'll deal with within the questions rather than on the mind map, because the landscape or an amount of landscape required to run down each of the calculations is absolutely humongous. So let's focus in on the high-level theory and the high-level terms, just to give you some background before we look at questions. So we've said that there's a parent. Now, the parent is the company, in effect, that controls one, let's say, or indeed more subsidiaries. In other words, it's the holding company. It buys shares in subsidiary companies, perhaps 80%, 90%, etc. Now, note that the percentage is important in order to establish control. More of that later. The subsidiary obviously is the entity that is controlled by the parent, and indeed the subsidiary's accounts are what's brought into play in the consolidated financial statements. What about control? Well, control is an important word, because I guess, without control, regardless of the level of shareholding, we have a bit of an issue. Because consolidated financial statements are very much based on control. Now, outside of FA, control can mean different things. So, for example, a company might own 90% of the ordinary share capital, but because of a technicality, because of a contractual arrangement, it may well be that they don't have control. We're talking about being able to control the actions of the company. So the company might be set up in such a way that, in fact, it doesn't have control. So that's important. More of that in a moment. The consolidated financial statements are obviously the entirety of the financial statements, including all subsidiaries, all companies within that group. Next area here is important. Non-controlling interest. This isn't a term that you'll be familiar with throughout the FA course. And in essence, what we mean by this is the element of shareholding, in effect, that the parent company or the holding company does not control. So on a simple level, let's say that we have an 80% holding of ordinary shares in company B by company A, then 20% is the non-controlled interest. Now, that non-controlled interest or non-controlling interest could be made up of a variety of different investors. possibly institutions, members of the public, you and me, etc., etc. But at the end of the day, whoever is the controller of those shares forms part of this non-controlling interest. And indeed, they don't have enough of an interest in the company in the form of shares to really control too much at all, but they do have an interest in the company. Now, in terms of the trade investment, we're moving on a slight tangent here. Really, what we're talking about is an investment, rather than an investment in a subsidiary as such, perhaps a small investment that is made simply to gain wealth, perhaps a shareholding in another company, possibly in a different industry. That's slightly different than having perhaps an investment in a subsidiary as such. Okay, let's move from there to really this idea of control. Now, we mentioned up top that control can be defined as a number of different things, but for our purposes, certainly within the FA syllabus, we're talking about more than 50% of the ordinary equity shares. Now, it does say within brackets here, giving them more than 50% of the voting rights, but as I mentioned with my example of 90%, that could be the case outside of the FA syllabus, that in fact, even with 90%, they don't have the voting rights. So we assume that 50% of the ordinary equity shares means 50% of the voting rights. And that's the degree or level to which it'll be examined within the FA exam. Nothing to worry about in terms of slightly spurious or dubious accounting arrangements or contractual arrangements that don't equate the number of shares or the percentage holding of shares with voting rights. One and the same for us at FA purposes. So in terms of the consolidated statement of financial position, we know a statement of financial position is in essence two statements basically related to assets and liabilities. But what about preparing the consolidated statement? Well, as we saw within the ACCA Study Hub, a number of different steps, or if you will, a number of different calculations are required. Now remember, this particular mind map video is about oversee the whole thing rather than to go into the real nuts and bolts or details. So let me talk about these areas. The total net assets of the group. I mean, clearly, when we think of the word net assets, we're talking about assets less liabilities. Outside of that, let's include the parent's reserves only. Now note, this is important and will be examined in the OT question. When we look at a set of consolidated financial statements, and in particular the statement of financial position, we're only looking to see the parent's reserves, not the subsidiaries' reserves, because if we did that, we'd be double counting, wouldn't we? Because we're bringing in an investment, we're bringing in assets and liabilities. We don't want to bring in a double count. More of that in a moment. In terms of calculating goodwill, I think we know what goodwill is in a broad sense, having been through the study hub or possibly in relation to your past studies. I mean, goodwill is essentially the difference, isn't it, between net assets of a given business and indeed what the consideration is or what has been paid for the business. And that won't necessarily obviously be shown on a subsidiary's balance sheet because it could be goodwill inherent in the business. Outside of that, we've touched on non-controlling interest. We don't know too much so far, but what we do know is more often than not, certainly within the OT questions at FA, there's going to be a set of percentage shareholdings that are not controlled by the parent or by the head company. Outside of that, this word's important, or these words are important, retained earnings. Again, from past studies and past chapters, I think we know what retained earnings are, aren't we? They are a reserve. Now, obviously, the parent has retained earnings, i.e. the head company, but also the subsidiary will have retained earnings, not just at the point of acquisition, but also at the point of consolidation. So this area is important for us, and understanding, the difference between pre-acquisition reserves and indeed post-acquisition reserves. Obviously, in terms of post-acquisition reserves, they're from the acquisition date all the way through to the consolidated statement of financial position date. Let's be careful in this area. Now, opening that up, in terms of calculation, when we talk about the statement of financial position, it should only include, as we touched on up top, the parent's share of post-acquisition profits. Now, why is that? Well, really, prior to acquisition, the parent didn't have any interest in the business. From the point of acquisition, let's say a given date, 1st of January, from that point, the parent obviously has a share, but the parent didn't exist prior to that point. So how would we calculate this post-acquisition profits? The calculation itself is not overly complex. Note, it is the parent's percentage of share capital, clearly, let's say 80%, times the retained earnings at the statement of financial position date, in other words, the consolidated statement date, less retained earnings when the subsidiaries are required. That must be post-acquisition because we're comparing 2 points in time, aren't we? We're comparing, let's say, today, or the consolidated financial statements date, 31st of December 2024, and we're taking off any earnings at the date of acquisition. That must be the parent's share of post-acquisition profits. Now note, as we've mentioned up top, non-controlling interests. They're important and they have a share of this particular business. So how do we calculate that? Well, the fair value of NCI at acquisition, normally given in the question, plus the NCI's share of post-acquisition profits, calculated similar to above, i.e. the percentage, for argument's sake, 20%, times the post-acquisition profits. Now that post-acquisition profits, as we saw in the calculation here, is quite easy to see because it's the difference between 2 points in time in terms of profits. One, the acquisition date, and one, the consolidated statement of financial position date, i.e. today. Okay, so quite a lot of information here, I understand. Now, in terms of goodwill, we know what it is. Let me just go back 1 second. We know what it is. So it is, the fair value of the consideration. In other words, this is the amount paid for that investment of, let's say, 80%. Now, note that we have to add in the fair value of non-controlling interest because we haven't bought the non-controlling interest. They still own 20%. So if you will, that might be sort of 80%. This might be 20%. And note, in order to calculate goodwill, we take off the fair value of the subsidiary's net assets at acquisition. Why do we do that? Because, as mentioned up top, prior to acquisition, there was no payment. So we get to the point in time that is the acquisition date, and we must compare at that point fair value or market value of the assets with what was actually paid technically, which was the consideration and the fair value of NCI. That must give us, i.e. the difference, must be the goodwill. That's what you paid over and above, in effect, the fair values. Okay? Let's move on from there to adjustments. The fair value consideration is quite easy to really decipher in the accounts and indeed in the OT questions. We're really saying, what did you pay? What was the consideration as a parent that you gave to the existing, let's say, 80% shareholders for your share? Well, how would I figure that out? Well, it's certainly the number of parent shares given times the market price of the parent shares. We're assuming, obviously, in this case, there's a value attached to the market price given in the question. So there's the consideration, or the amount of money, cash if you will, given in terms of consideration. What about the fair value of the subsidiary's net assets? Well, again, not overly complicated. Again, as we saw up top, we're looking at the parent's percentage share of the share capital, i.e., let's say 80%, and then the retained earnings as at the statement of financial position date, current, less the retained earnings when the subsidiary was acquired. So in essence, we're talking about just, again, a comparison of two things. Okay. Let's move on from there in terms of some, again, slight quirky little calculations. Intragroup trading. Now, it stands to reason that if we've got two fairly sizable companies, that there's a chance that they trade with each other. Okay, and in accordance with stated consolidated financial accounts policy, we need to remove that element because we need to offset. That's a key principle within consolidated financial statements. And we see intercompany receivables and payables. So in essence, what we're talking about here is a contra. Yeah. So on the one hand, we have, let's say, a parent buying goods from a subsidiary. There's going to be a receivables balance and indeed a payables balance. Let's say a payables in respect of the parent and receivables on the other side. What we must do is exclude that amount from the accounts. That's the logic behind this particular adjustment to the accounts. We have to offset. Otherwise, when we look at a set of accounts, we've got receivables that are too high, coupled with, on exactly the opposite side, payables that are too high. We need to use that principle of offsetting. In terms of the intercompany sales of inventory, this is a little bit more complex, and I haven't gone into detail here because we're doing an overview. But in essence, if we have inventory that's unsold, we're going to have not only that inventory, but also the profit element. So I'd refer you to the double entry within the chapter for that, but more particularly to doing OT style questions, because I think that is the way to get the adjustments right. Let's remember that within a given FA exam, the likelihood of a multitude of questions, for example, on this area is very, very low, perhaps one or two. So getting a fix on this is important. Yes, it's a little bit tricky. Yes, this adjustment here is fairly straightforward. Okay. Let's move on from there. In terms of mid-year acquisitions, we've assumed so far that really our approach to consolidating a set of accounts is where the parent and the subsidiary have what we would call coterminous year ends. So, for example, the 31st of December. And indeed, over and above that, the acquisition takes place. The transaction where the parent buys the subsidiary takes place at the beginning of the year. That's the broad assumption. But what if it doesn't? What if it takes place mid-year? Now, again, there are some tricky little adjustments here. But in essence, what we're talking about across these four areas is really just accounting for the difference in time between the beginning of the year and indeed the acquisition date. So, for example, let's just say the acquisition occurred on the 1st of July. Then, in effect, we've got 6 months pre-acquisition and we have 6 months post-acquisition, and we have to adjust our numbers as calculated above for that pro rata element. Again, it's the sorts of calculations that won't work quite well or well at all within a mind map, and we'll work them within the questions. Okay. Moving on from there to the consolidated statement of profit and loss. Now, for me, when I think about consolidated financial statements, I do think that the P&L is a little bit more straightforward than the balance sheet. Let me explain what I mean. Well, when we think about steps, what we need to do, obviously, first and foremost, is to determine the date of the acquisition. And with the figures, generally speaking, in the P&L account, we simply prorate. So, for example, revenue and cost of sales. Let's say if it was 6 months during the year, we prorate. If it's a full year, we don't need to. Outside of that, in essence, this whole area of combining two sets of profit and loss accounts, for me, is much, much straightforward than combining two sets of statement of financial position. And I think you'll agree and see that from the questions as we walk through them. In terms of intergroup trading, similar sort of area here in terms of what we saw on the right-hand side, although I included a little bit of detail. The effects of intergroup trading must be removed. So in the first instance, sales of inventory, and you can see the double entry is quite straightforward. In other words, we're in effect saying what we don't want to do is to have revenue and indeed cost of sales inflated by transactions between these two entities, assuming one subsidiary and indeed one parent. Okay? Outside of that, we know that there's a possibility of dividends. Yeah? In other words, from the subsidiary to the parent, an adjustment is required there because, again, we are inflating. So how would we deal with that? Well, simply remove it. So we debit other dividends or debit income to remove the income, and we credit retained earnings, in effect reversing out that entry as if it never happened, because we want to offset and show accurate figures. Moving from there, in terms of mid-year acquisitions, as I touched on up top when we started on the P&L issue, really only the subsidiaries' revenue and costs of post-acquisition will be included. Okay, so again, if we had a 1st of July cut-off date or acquisition date, we'd be looking for revenue and costs joined up from that point, pro rata 6/12. In terms of post-acquisition, again, same thing, the calculation of the NCI shares, 6 months only, assuming, let's say, 1st of July with coterminous dates of 31st of December. So a similar sort of process. In terms of investments in associates, we've talked so far mainly of companies acquiring a substantial investment, more than 50%. Okay, let's call it 80% to be easy. Now, associates are different. In terms of definition and identification, we're talking about much lower. So ballpark figures, we're talking about around about 20 to 50% or thereabouts. An associate is an entity in which a company has invested, where the investor has significant influence, but not a significant shareholding, i.e. more than 50%. Now, this word or phrase, significant influence, is important, because let's think about it. Even if you are not dealing with a parent subsidiary relationship, if you have 30%, 25, 35% shareholding, you are more likely to have some sort of influence, very possibly a significant influence, meaning the power to participate in financial and operating policy decisions. Imagine yourself running as the CEO a large multinational where you hold significant percentage holdings, 30, 35, etc., in different countries around the world. You're likely to have some sort of sway. So what it's evidenced by over and above the shareholding? Well, perhaps representation on the board, perhaps some sort of impact on policy making, significant transactions for sure, maybe even duplication or interchange of personnel from time to time, or possibly even the provision of technical information or technical expertise. So these are things over and above the actual shareholding. Okay? Note, we're talking about an associated company, not a subsidiary company. In terms of equity accounting, this is low-level importance because it's not going to be examined, as you'll see within the study hub, that we're specifically told equity accounting is not relevant, strictly speaking. We're talking about the associates' post-tax profits and the dividend element. So not really relevant to us at all. I don't expect questions really in this area. Okay? So this concludes the chapter. As I say, really an overview of the chapter. What we're going to focus in on is the questions and indeed the tricky little technical qualifications. Really, my advice would be at least to be going over the study hub detail, certainly at least twice, possibly more. Reading into the mind map video that you just listened to in certain areas to get an overview feel, but certainly making the bulk of the time that you spend on this particular chapter in terms of bashing out the questions. You'll see in the OT section that there are the largest number of OT questions for this particular chapter. I think 90, possibly even 91 questions, which is much, much more than any other chapter. That gives us an idea of emphasis on behalf of the examiner. Okay, so more work to do here, but hopefully this particular video has given you some sort of underlying guidance and a little bit of comfort. Okay, thanks for listening.